Hello accounts people, time to have a look at ratios, focusing on the 4 ratios for the level 3 AAT syllabus. So first of all, most ratios are actually percentages. There are a couple that are still occasionally calculated as a ratio, in other words something to 1. These were all ratios once upon a time. These are all used to assess the performance of a business. There are others to assess liquidity, including the ones that are usually ratios, or help identify issues within a business structure. They're not covered by any rule, IAS or IFRS, so you may see a slightly different formula on some, particularly the ROCE. There's others that have quite a few different formulas different people use. We're also going to compare them with previous years, so are we better or worse, improved or deteriorated to last year? Better or worse than a similar company? Can't compare them with a different company, and there's nothing to do with us. Or are we better or worse than the industry average, a figure that would probably be given us by a trade body. So first of all, the gross profit margin. So a change in the gross profit margin is only caused by a change in the unit cost or the unit selling price. Maybe a strategic decision, so selling goods with a higher market position usually increases the margin, so if we manage to go up market. So we were a discounter, now we're a mainstream or elitist goods. And you'd expect to see the margin on a Rolls Royce being higher than the margin on a Mini. Like the cost though, may just be due to inflation. Businesses will use these calculations to see the effects of inflation and the costs. So volume is only an indirect cause of the change in selling price or cost per unit, so it won't be an answer in the question. Students often get that one wrong. We may lower the prices to sell more, or if we sell more we can get economies of scale, or we could lose economies of scale. We'll demonstrate that in these calculations. So a higher percentage is usually better, unless we've given ourselves such a high margin we haven't got any sales, and therefore no profits, or no turnover, or very low turnover. So we're going to keep to some fairly straightforward numbers. I've got a selling price of £3 and a cost per unit of £2, and do a lot of the calculations based on 1,000 units made or sold. So the revenue would be £3,000, £3 times 1,000. Cost of goods 2,000, giving us a gross profit of 1,000. Gross profit divided by revenue times 100 is 33%. So let's see if the volume changes. Well, I can add 20%. Our revenue goes up, our cost of goods goes up, the gross profit's gone up, but our margin stays the same. So it doesn't matter how many we make, our margin will stay the same. Back to that number. So let's change the cost or price. This is where it will actually matter. So if I take 10% off our selling price, we should of course sell more units, but you can see the margin going down. If I take the same percentage off my cost per unit, the margin goes back to where it was. Increase the price without and reduce the cost per unit, I've got a better margin. Doesn't matter how many we sell, that margin will stay the same, although the actual figure for gross profit increases if we sell more units. So the volume itself will be reflected in the net operating profit margin. Net or profit for the year for sole traders operating for companies. And this is because we're now introducing the overheads, which are mainly fixed. So if we make more units, that overhead is spread over more units, level 2 costing. So, but we're calculating these figures on our income statement, profit or loss, after the gross profit. So if the gross profit margin goes up, so should our net profit margin. We'll show that, of course. So let's just do a nice simple one. Reduce the overheads, and suddenly our operating profit margin, net profit margin goes up. That one, not particularly difficult calculation. However, let's see the effects of volume. So remember, volume doesn't change the gross profit margin, but actually it's now an increase in volume has actually increased our operating profit margin and net profit margin. That's the same overheads being split between 1200 units, so lower cost per unit. I can go in better, be really greedy, and you can see it going up. Back to where we were. Now, if the gross profit margin changes, the operating profit margin changes, so let's do the same calculations we did earlier. So this one reduced our margin here. We've actually made a loss now, and the net margin reduces as a result, unless of course I make more units. I've reduced the price by 10%. See what this does. Oh, not good. Still not good. Still a loss. And of course the gross profit margin is still lower. So it would actually take more than a 10% increase in sales to compensate for the 10% loss in selling price in revenue. Something quite big actually to get back to where we were. So those are the margins, so nothing to do with volume. Practical terms, yes, it may give you an economy of scale. This one reflects the volume more because of the fixed nature or semi-variable nature of most of our overheads. So next one's ROCE. Now I've only ever calculated this for a limited company in the real world, however we can apply it to sole traders, and it tells the shareholders how well the directors have been using the money they've got available to them. That's the investments, the shares, plus any loans that they've had. It's so important, I actually sometimes call it the mother of all ratios. Possibly the first one you do is at an AGM when somebody hands you a copy of the financial statements. So the formula for a limited company is operating profit over the equity plus the non-current liabilities. Now I haven't seen this in the AAT practice papers, but I have seen it in some of the publishers' question banks, which is why we need to understand the difference. But by and large it's still telling you the same thing. In sole traders, profit for the year, or net profit because it's easier to say, over the capital employed, opening capital plus non-current liabilities, the same loans. There is a bit of an issue though on non-current liabilities. Loans for a sole trader, they are the same business entity. Sometimes a personal loan can't be included in this calculation. Higher will always be better. It's a better return on your investment, on the money you have to play with. So any change will be due to one or more of the components. So think top and bottom halves of the formula. It's either a change in the profit, the capital, or the loan, or anything else that's included in these figures. So an increase in profits, the top half will increase the percentage. We'll do some calculations in a minute, and vice versa. Reduce your profits, less return on your investment. Increase in capital reduces the ratio, the percentage, the bottom half, and vice versa. So if you reduce the capital, maybe you made a loss the year before, ROCE can go up the following year. A new loan will reduce, again because you've increased the bottom half. Paying off a loan will increase. And then the point about personal loans and sole trader. It's an accounting conundrum. Sole traders' capital should normally increase year on year because you've seen the formula: opening capital plus profit minus drawings equals closing capital. But actually the capital that created that profit was the opening capital, so you shouldn't be using the closing capital. So let's have a look at some of the numbers. We've got some fairly straightforward numbers here. We've made a profit of £5,000. Doesn't matter whether this is the sole traders or limited companies version. Capital equity of 6,000 and a loan of 1,000. That gives us 5,000 over 7,000 times 100 is 71%. If we make a bit more money, the ROCE goes upwards. If our capital had gone up, that would reduce it. If we pay off a loan, that increases it. Take out a new loan, reduces it. So think top half and bottom half, and you won't go far wrong on this. Analyse it. Think about the components of the formula. So the last one, mathematically, is the nice simple one. The reasoning, the possibilities are wider though in terms of business accounts. It's any expense figure as a percentage of revenue. Of course, limited companies only have 4 cost figures in accounts, or they only have to have 4 costs in their accounts. Sole traders though tend to have a bigger range of costs. This is because the individual figures may be useful to the sole trader. They can understand, they can relate to them. So the shareholders in a limited company, they're more investors, hence they're happy with the simplified IAS 1 version for limited companies. A higher percentage may indicate costs that hasn't been controlled or beyond control. Of course, lots of costs, lots of overheads go up and you can't do anything about them. Fuel prices at the moment, utilities prices at the moment. Lower means good control or a natural reduction. So if you use diminishing balance, your depreciation charge will go down every year. This could actually mean that the depreciation as a percentage of turnover reduces, which of course generally looks good. But does it really tell you the whole story? No, it's just a bit of information to help analyse, tell a story about what's happening in the business. They're all against the revenue. Lots of expenses are fixed or semi-variable. So the revenue increases or they rise if the revenue decreases. So let's have a play around with some numbers. We've now got 10,000 units at £1. Cost of sales 60p each. So we've got the cost of sales, gross profit margin and a margin. We've got some admin costs, that's a semi-variable, fixed part variable, rent purely fixed, travel semi-variable. So let's just have a look, see what can happen. If we sell more units, the margin will of course, 10% more units, still stay at 40%, the gross profit margin. But although these costs have gone up a little bit, I think I've put an extra 0 in there, that's better. Meant to do that one. That's looking a little bit healthier because we sold more units. Goes up to 15,000, and not only is the margin still 40% because it's only the units that have changed, but the fixed element of the expenses is spread over more units, so we've got a better net or operating profit margin. If we actually change these numbers, we can see what happens. We'll stick with these numbers so far because they're actually making a profit. If our rent goes up, doesn't affect the gross profit margin, but it will reduce the operating profit margin. If we get fed up with sticking in traffic jams and buy a bike, operating profit can go up. But of course the gross profit margin hasn't changed because it's below the line. So as these change, so just to remind you, if we change these a little bit, the margin goes up and therefore the operating profit will go up, which is a very important effect. And that's ratios for now.